Welcome to Total Return with Division 1 Finance. My name is Deron Forbes, and my goal is to help you improve your returns by keeping you up to date with everything that you need to know. We don't fall victim to marketing schemes of major institutions, and we don't settle for mediocre returns. What helps investors beat the market is information and the knowledge of how to use it. We'll provide you with both. Be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. Tesla has dominated the headlines for quite some time now. After a massive short squeeze to close out 2020 forced the stock into the S&P 500, the company rose to a $1 trillion market valuation, sparking debates throughout 2021 as to whether or not they can live up to those high expectations. Despite those who remain bullish on the stock screaming from mountaintops about their EV dominance, the downfall of Tesla's common stock has become the new narrative, with a CEO who seems determined to ensure that Wall Street doubts his ability to stay focused on the task at hand. The question becomes, how much of a margin of safety do investors truly need? And is there a margin of safety at all? Today, Tesla closed below the $200 level for the first time in 2022. While that may seem like a good thing to some because it shows that the stock has been somewhat resilient, let me remind you that the company has lost over 49% of its market value year to date. Yet and still, from a technical and a fundamental perspective, projections seem to be that there's more downside to come. The thought process behind Tesla is that they will continue to produce cars at a record pace, increasing their sales by 50% year over year for the next 5 years, decreasing costs along the way to continue to make those sales more profitable for their investors. The problem is that Tesla was already priced well above expectations. This forces Elon Musk and the rest of his team to try to drive additional revenue out of energy and other services. The question is, can it actually work when the original valuation clearly had the thought in mind that Tesla's competitors wouldn't eat into their EV demand? For this reason, I've never believed that Tesla can hold on to that $1 trillion valuation. The company does score well in terms of returns and economic benefits, but investors get too emotionally involved in Tesla's brand, taking on the risk of paying too high of a premium before a correction in price. Now we're going to dig a little bit into the value of Tesla. Make sure that you stick around because what I'm about to say next is the most important part of this episode. As an investor, you should definitely research every company before putting money into it. But the price that you eventually pay is what matters because that's what determines the type of returns that you see. We're going to take a look at Tesla's valuations, economic benefits, what the company may be really worth, and what that means we can expect from them in the future. This is known as the present value of growth opportunities. At first glance, I see a high-grossing business who generates great return on equity, whose stock is in a long-term uptrend, and 5-year total return is greater than the S&P 500. But with no stock repurchases and no dividend to depend on, this means that all we have to look forward to is capital appreciation. While the company does generate strong revenue and earnings growth, and their current liabilities are well covered with quick assets, the first red flag for me is that Tesla only converts about 27.4% of their earnings into free cash flow. While that may be a concerning factor for me, the biggest problem for Tesla is not in their economic benefits and their returns. The biggest problem is still within their valuations. Tesla's current share price still suggests that the company will have a compounded annual growth rate of over 40% year over year for the next 5 years. While I would love to believe this is possible, investors who buy Tesla stock today are betting that the stock will be flawless for the next 5 years with no decrease in demand, no increase in competition, and no adverse effects from the antics of Elon Musk. This is why I would advise that any investor seek out a margin of safety. At $140 per share, which is the true value of Tesla's earnings with interest rates at 4%, the company would only have to grow revenue by 30% per year over the next 5 years to live up to expectations. Now, a lot of people are going to call me crazy, But I believe the intrinsic value of Tesla is closer to $95 per share, which still calls for it to outperform the S&P 500, but with a more reasonable revenue growth rate of around 21%. Far be it from me to tell investors what to do with their money, but one of the main reasons that I've outperformed the market over the past 8 years is that I've always looked for the best companies, but only at the best price. Tesla can still be a great investment, but I wouldn't be buying this company above 440 billion. This still puts them well above other auto manufacturers, but prices in the reality that I can't see 5 years into the future. That competition doesn't just go away because you decided on who you thought the winner would be, and that all investments don't work out. I wish everybody who decides to invest in this company the best of luck, but keep in mind everything that was said here, because a penny saved is a penny earned.